Did you know that there are two debt ratios that most mortgage lenders and most mortgage loan products are looking at when it comes to an approval on a mortgage? Hi, this is Recharging with Champions, and here's a little tidbit that you could throw in your social media. You could create this video if you would like about debt ratios, and that there are two that lenders are looking at to qualify someone to buy. The first one is the front end debt ratio. The front end debt ratio just means all of the things that are included in the mortgage. So you've got your principal and interest, your taxes and insurance, your homeowners associations if there's a homeowners association, and MI if there's MI or PMI on the loan. All of those things are lumped together, and that is what is going to be used to find out what that front end debt ratio is. The math here is take that total, divide it by the gross monthly income, and that is going to give you your front end ratio, which is oftentimes required to be a little bit lower than your back end debt ratio. The back end debt ratio is that number plus all of the other debts that the borrower has. These can be everything from car payments, other mortgage payments, installment loans, student loans, credit cards, any of those things that they have to pay monthly, including things like child support or alimony or anything that's even privately held. So that back end debt ratio is everything that the person is going to owe when that loan commences, including what was in the front end ratio. So you take that front end plus all the other debts, you add that together, and then you divide that by your gross monthly income. And that is your back end debt ratio. And remember, you might hear a lender call this your DTI. They might say your front end ratio, your back end ratio, or your DTI. That is what they're talking about. And what we need to make sure is in line with the loan product that you're going for's program guides. Some of them are a little bit more picky. USDA likes a nice low front end ratio and a pretty reasonably conservative back end ratio, whereas FHA is a little bit more lenient. They're going to allow for a higher front end and back end debt ratio. Conventional, it just depends on the loan. Remember, there's all kinds of things that are going into your loan approval, but that debt ratio is very important. Stick with me this week. We're going to talk more about debt ratio, what goes into it, and a couple of hints you really want to make sure that your buyers are aware of as they start the process. Remember, May scripts on the Recharging with Champions website. That's www.rechargingwithchampions.com. Go to the members area, check out the scripts. In the May script area, you will have a script for this so that you don't have to memorize everything I just told you. You can actually just read the script and make your own video. Also, make sure you check out the rest of this week for some great information to share all about debt ratio.